All right, well, welcome to this very special webinar, the Fundamentals of Precious Metals Investing 2012 edition. This logo may seem familiar. We have used this before in the past, but now is a different year. We're in 2012, and there is a lot of things going on. Our country is in a large amount of turmoil. As we look around the country, we have reason to be concerned about the direction and future. We have plenty of concern for our children and our grandchildren, and tonight we're going to be talking about some of the facts on the ground and some things that you can do, especially with precious metals. And it does seem that precious metals have become very popular as of late, not as popular as that we think they're eventually going to become, but they're certainly becoming more popular. This is me. My name is Jerry Robinson. You're listening to myself and also Tom Cloud. I'll introduce him just momentarily. I'm the editor-in-chief over at FTM Daily, and I'm an economist, a published author of the book Bankruptcy of Our Nation, and you can learn more about me at ftmdaily.com. I'm being joined tonight by Tom Cloud. He is a precious metals advisor in the business for, well, since 1977, so that's more than 35 years, Tom. You've been doing this. It's great to have you tonight.
Well, it's great to be here, Jerry. It's always a pleasure. I am having a little trouble with my screen, but the whole time earlier it worked, but for some reason it's giving me little problems.
Oh, are you having a difficult time seeing it? Okay. Well, you'll be able to follow along, I guess, with the slides. I'll be sure to tell you which slide we're on. If
yeah, you just tell me which slide. I know them.
Yeah, no sweat at all. All right, well, we're going to dive right in and remind you that we are using our 5 levels of financial freedom. There is the logo. You'll find that on our website. And tonight we're talking about primarily level 3 and somewhat of level 4, and possibly even level 5 as we get into some diamond investing and whatnot. But we're going to be talking about tonight gold, silver, palladium, and we're also going to be talking about diamonds. And we have some really interesting new information on diamonds, which we're going to be sharing with you tonight. Very interesting. And so for those of you who are investing, this is good for you to know where we are in these levels. If you're not familiar with this level, feel free to go to ftmdaily.com and learn more about our 5 levels of financial freedom. We also talk about PACE, precious metals, agricultural commodities, and energy. This is the FTM financial philosophy to investing. It's a wealth strategy for building diversified investments, and we all know the reason why we need to have diversified investments, because the rules of the game can change. We never know when something might change. Speaking of change, we are not seeing much change on the front of interest rates, Tom. Interest rates are at near zero until 2014, and we're looking at a slide right now with Ben Bernanke and thinking about what has been stated as of late, that not only are they going to keep interest rates low until the end of 2014, they're talking about keeping them near zero artificially until the end of 14. What say you?
Well, I mean, I think it's ridiculous, Jerry. We know when you do that, let's just say the inflation rate is 3%, even though John Williams of Shadow Stats is telling us right now, the fellow that has kept the official statistics for years, and we've got nearly a 9% inflation. They're telling us it's between 2 and 3. We're loaning banks zero on federal funds rate. Then we're going out this year. We've already seen the 30-year bond rate go up 50 or 60 basis points. And if this thing continues to 2014, we're talking about something on the order of $3 trillion. Just think about it for a minute. If you're going to loan money to a bank for zero, basically overnight rates, they take those funds and loan them to try to keep the economy going. So really what they're doing is trying to have an accomplice in trying to keep the economy from going under. So but the whole time you're going out in the market and borrowing money from the Chinese, the Russians, pension plans, and you're paying them between 3 and 4% on 10 to 30-year bonds, and yet you're loaning money at zero. So we think it's going to take, it's a $3.5 trillion experiment that is going to be a trigger to inflation and it's just another way they try to put money into the economy from all different directions, and yet it's so costly. It's looking like we'll probably have to raise the debt ceiling at least 2 or 3 times between now and 2014.
Yeah, and I've heard a lot of allusions to the similarities between us and Japan with the low interest rates, and of course Japan fell into that, to that liquidity trap, and of course they faced a lot of deflation. But I don't foresee that for the United States with our international reserve currency. I mean, we're going to have a lot of those dollars flowing back, and low interest rates won't cut it. Tom, I want to tell you that I have emailed you the slides since you're not able to see them. So if you check your email, you'll be able to follow along, which makes it much easier for you.
Okay.
So I sent it over to your email. Put up another slide now with Casey Research showing the fact that the effective Fed funds rate has been near zero for some time, and they're continuing to keep it zero. And Tom, you remember when we often do our conference, our Building True Wealth conference, we show how this has been the consistent Greenspan doctrine. Since 1987, the way you deal with crises is you cut interest rates and you, in effect, print money by doing so. And this has been the Greenspan doctrine: cut rates, keep rates ultimately low, and it created the dot-com bubble. It created the speculation that we saw in the real estate bubble. And now coming out of this, we see these monetary authorities, it's basically saying, we're just going to keep rates low. I mean, whenever everyone knows, Tom, that that's what caused our problems in the first place. So they're fighting fire with fire, and anyone who doesn't see the train heading for the brick wall needs to wake up.
Well, exactly. It's I just really, and later in the talk, I'll talk about a slide that I presented this past weekend at a conference in Spokane, Washington, and I'll go over that slide. But the thinking of people that the economy's improving and they're just sitting there looking, as we know the Greece situation just keeps being stretched out. We know that the citizens of Greece are not going to vote to cut their pension. So we know they're going to be relieved from the euro, and probably in the year 2012, and when they do, with 40% of the brokerage firm money in this country tied to commercial paper and European debt, and you look at what's going on in Portugal and Spain, and all the rates have been cut this week, all the downgrades that have happened in Europe. I mean, I don't know what people are thinking. I just really don't understand it. It's, I mean, we've really been talking about this, and it's been, just keeps going, and the U.S. has done everything they can to keep the stock market up, and it's only gone up 5% in 11 years, and they do everything they can to keep gold and silver down, and both of them are up over 5 times that we'll get into a little later. But all that's breaking up now, and you're now seeing major money from institutions and people move in and out of these kind of investments, and all you have to do is follow it. But this is the year that the great transfer of wealth begins in earnest.
Good point. I do want to talk about that transfer of wealth too, because we'll talk about that toward the end. Now, do you have those slides in front of you now, Tom?
I don't, but just going, I pretty much know them all. So.
Okay, perfect. All right. So the next one is the Fed funds rate. It's a interesting looking chart, kind of a head and shoulders looking chart of the 1954 through 2011 Fed funds rate. Interesting. It tells a story here. What does it tell?
Well, it just tells what we've been talking about. It tells us that they cut it to zero. They're willing to put it below inflation rate, so you know right away your money is going to be worth less next month than it is this month when you have an inflation rate above the interest rates. And all you got to do is look through history, going back to Jimmy Carter in 1980, and see when they placed these rates way below the inflation rate, and you know how fast it can makes the inflation rate go up and the value of the dollar go down. Well, the United States has had a break in that Europe's having these problems, that ours are much larger that are coming, than what they have. And even with all that, the dollar still will not go up. It's only up from 72 in 2008 when all the problems started, from 72 up to 79. It's only gone up 10% in 4 years when everything in the world's gone wrong that can go wrong in Europe, and the dollar still won't spike up. So it's just telling us that they're doing everything they can to keep the economy, and they're looking at every avenue they can to get liquidity in the market, and this is just one of the tools they use.
Interesting point here. As we look at this, you'll see that in these the late 70s, those Jimmy Carter years, you'll see that the interest rates began to climb as they were trying to deal and grapple with a lot of issues. And you'll notice the spike that came from Paul Volcker at the Fed whenever he raised rates just dramatically. And of course, that caused the economy to rapidly change. And we began to see then a decrease of interest rates as time went on into the Reagan era. And what's interesting today is that we don't really have that option anymore, because imagine yourself having, let's say that you're really broke, let's say that you're unemployed, and let's say that you have a credit card bill that comes in every single month, and you look at and you stare at the statement and you say, man, I've got to make this $300 payment on this credit card. How would you like for your interest rate to go from 25%, if you have a 25% loan, all the way up to a 2,500%? Would you be able to afford that? That's exactly the place that America is in today, because they don't have the option of raising rates up to 20%. Can you imagine what that looks like on a $1 trillion deficit? Can you imagine what that looks like on the $15 trillion that we have? We certainly don't have the option of raising rates that dramatically. So in many ways, the Fed really is out of bullets. Should they raise rates? Absolutely. But is it going to be the option that's really going to save the dollar? I don't think that they really have enough room, Tom, to really make it happen. I think we're in that final spiral. There is another slide here, Tom, that shows how gold rises with the debt limit increases, and this is a stunning chart.
Yeah, and what I've done here, I've called up my iPhone, so I do have it in front of me, and that is the most stunning chart, because that comes from a Korean economist that is very well known for managing money, Dr. Yu. And what's stunning about it is every time the U.S. Congress and Senate has gone to raise the debt limit, you can just see the devaluation of the dollar and watch gold up. And on August the 4th, when they raised the debt limit, and everybody's talking about the government going out of business, and they were going to shut it down, and all the senators and congressmen, not all of them, but most of them end up voting and saving the shutdown at the last minute. We pumped $1.2 trillion in there, and here we are 6 months later, and we're finding out all we have left is $24 billion out of $1.2 trillion, and we're going to be raising the debt ceiling again early in March, or by the end of March, and we're going to go through this fight again about shutting down the government. It's an election year, and it's going to get very interesting, especially for people running for re-election that vote to raise the debt limit, and yet there's a lot of pressure on senators and congressmen from the citizens of the states, because they're concerned about their family and their jobs, and they're wanting them to try to fix it some other way than not raising the debt ceiling. But we all know they'll raise the debt ceiling. If you raise the debt ceiling another $1 trillion, $200 or $300 billion, then what happens in 5 or 6 months when we have to do it again? So you just watch gold. It'll just go right with the step ladder with that graph that you're looking at. It'll just go right up, no matter the volatility will be there, the talk will be there, there'll be negative days, there'll be positive days, but that's all part of the plan, is to get weak hands out of gold, and that's when you have to be the strongest.
The next chart, Tom, is the unfunded liabilities and the official government debt. Why don't you spend some time talking about this, especially when it pertains to...
Well, let's talk about it quickly. I mean, if you look at it, we had $8 trillion over there. And the reason I use this 2009 slide is just to show you how much it's gone up in 3 years. It's pathetic. But the main thing, look over at Greece, and you can see what all the hoopla is about. And all these other countries, not all of them, but especially the ones to the left of Greece, they're going the same way. You just got the red line. The unfunded liability is just going straight up, straight up, straight up. And where's the money going to come from? It's got to either come from paying off in inflated dollars or through a huge deflationary contraction. And that's the reason you hear people talk about deflationary contraction. I don't think that's going to be the outcome personally, but I certainly understand that what we saw in Japan certainly could happen. But that's really the only point I wanted to make on that slide.
The next slide, we take a look at the United States national debt as it's risen from the time of Reagan all the way till now. It's 1980 to even projecting out to 2019. And if we take a highlighter or maybe a pen and we take a look here and take a look at the Bush years, we see that it really began to pick up right about here. We go out to 2009 right there, and you see that we're really dealing with a pretty big incline chart. But when we move into 2009, as Obama enters office, he's having another challenging thing to have to deal with. You notice that the incline even goes up even quicker. And so we're getting to a place, Tom, where it's beginning to go straight up.
Well, it is, Jerry. I mean, it took from George Washington through George Bush to run up $6.3 trillion of debt. And here, this president's gone from 6.3 to $15 trillion in 3 years and 2 months. I mean, this is unprecedented. I mean, it's absolutely amazing in that growth rate, because the interest keeps picking up in the federal budget deficit. And even when they came out with his new budget saying, oh, we're going to cut the budget deficit to only $1 trillion for next year. Well, here's the interesting point. Whether it's been a Republican or a Democrat in the White House, the last one that made a projection a year in advance and did it was Bill Clinton. So you can't do it. I mean, I think most of these listeners wouldn't be listening if they believe the government's numbers, but certainly we know the deficit's going to be far in excess of $1 trillion in the next 12 months, because interest rates to borrow money in the world market through 10-year notes and 30-year bonds is going to become more and more expensive. We're going to raise the debt ceiling. It's going to make money more and more expensive, and the dollar devalued, and it's just not realistic. So you've got to believe that this debt will double again in probably 3 years. We'll see 15 trillion go to 30 trillion. And if you took a best case scenario, it may take 4 years, but that's about the best you could hope for. And then we'll have $30 trillion in debt if the system hasn't crashed by then.
Amazing. The other thing that we also are pointing out on this next chart is 11 years of food stamp usage, Tom.
Well, you know, it's a thing. I was looking at some alternative things to see how gold, this primarily was looked at, and a friend of mine was telling me about this, and we started checking it out, and it's amazing. We're a country of a little over 300 million people, and as of the end of 2011, we now have 45 million people depending on food stamps. I mean, this counts families of 2 or 3 children, but it's grown almost directly with the price of gold. The food stamp usage has, and we've seen that the total participation is now up to nearly 15% of the population doing it, and over 45 million people. And if you look at the percentage that's gone up, it's been just exactly that the price of gold has gone up over the same period of time. So it's just another indicator that is very bullish for gold. And this food stamp, there's some projections out there that could be as many as 60 million people on food stamps by the end of 2013, you know, nearly less than 2 years away. So if that is true, we'll expect gold just to keep going up from another indicator that we usually don't look at.
Yeah, and one of the things that needs to be pointed out is that there are no current incentives in place to prevent these numbers from going up. If you take a look at Medicaid, if you take a look at Medicare, if you take a look at Social Security, they're not really being dealt with. And then, of course, if you take a look at what happens in the welfare system, there really is not anything occurring that is true reform. And so, obviously, there's a segment of the people that need to be taken care of, but there are no incentives being put in place in such a way to change the system, which means that 5 years from now, how can it possibly be any better? And therefore, things like gold and silver and palladium and the things we're talking about tonight are obviously going to be the beneficiaries. There were some new numbers out on housing starts today showing that they were, I believe, at a 3-year high. But, looking at this chart, it really doesn't say much. I mean, this chart shows.
That's my point. Exactly. Yeah. If you say houses up 41% from nothing, look at what it shows on the graph. And certainly I'd love to see the housing market recover. Who wouldn't? It's good for America. It's good for jobs. It brings jobs to many different industries. It helps your economy be strong and grow and create jobs and savings for America. But when you look at the way they do it, it's just so misleading to say that housing starts are up 41%, but look what 41% means. It means almost nothing. And that's my point of this slide.
Yeah, that's something. The official unemployment rate as well, we should also point that out. Here's a slide about that, Tom.
Well, yeah, I mean, we're hearing John Williams on shadowstats.com, and listeners, if you're looking for a very solid newsletter, it's $95 a year or something, but you can go on there at shadowstats.com, and John Williams is brilliant, and he puts out a lot of good indicators, and he is the godfather of statistics in this country. So, but he is saying right now, when you take off people that are underemployed, you take off people that have been looking for over 49 months, and you take all these people out, the real inflation rate is about 16%. I mean, I see unemployment going up in the state of Georgia, and we're sitting here with them, the government telling us unemployment is going down, and it's just not true. You can skew the numbers to read about anything you want, and it's just gotten to the point where you can't look at a single number that comes out that you can have faith in.
Yeah, that's unfortunate. Let's take a look at the currency in circulation. This chart is staggering when you take a look and see what happened, especially in the Greenspan years, and of course what we've seen in Bernanke's years. Straight up, Tom, straight up.
Well, it's like the Arab shows down there. When we went off the gold standard in 1971 with Nixon, we've had an increase of 18 times in 40 years of the money supply. It's gone up 1,800% or 18 times, ever how you want to say it, and you'll see what Bernanke took up right where Greenspan left off, and it's even turning up quicker. And if you go to the next slide, that is brand new, right out of the Federal Reserve of St. Louis. This is open to the public. Those gray areas are recessions, and you can see in 2008 what we call QE1 and QE2. You can see we were in a recession, and yet the money supply, the spigots were turned on wide open, and you can see that money growth going straight up during that time, and now we've seen an 18-time increase, and we're seeing some people project as much as 30 or 40 times increase from 1971 before the system blows up, and we have to go back to some kind of currency, but you can be assured it's coming. And when Stephen Forbes, that ran for president 4 years ago at the financial conference in New York in December in front of thousands of people, said there is no other end to this story except the gold standard, because it's the only thing in the world that every country can agree on as far as value goes. So at some point, whether it's 2, 3, 4, or 5 years, we're headed back to a gold standard which is money from the book of Genesis all the way up till 1971, and paper money was a receipt for real money. And this 40-year experiment has been a disaster in fiat money, and we will go back to a gold standard at some point in the not-too-distant future.
You know, I think it's interesting, too, because we've talked about over and over again about how money is debt, and we try to break that down for the folks on our show and all of this. And if you look at this, this is basically telling you that in December of 2011, we had $1.06 trillion in currency, okay? So that's how much money that was in circulation. That's the actual tangible cash that's out there that's actually in circulation. And, you know, we have a $15 trillion debt. And so when you begin to realize how debt-based this monetary system truly is, it really takes hold in that particular statistic, that there's really only just $1 trillion out there. So where does the rest exist? It exists in computers. It exists in it's fantasy. It's creative.
Derivatives, that's right.
It's unbelievable. All right, Tom, let's go to the next slide here. This is the stock gains versus the precious metals gains.
Well, this is really important. Yeah. You know, I think my biggest pet peeve over the last decade has been, I'll talk to a client and they say, well, my stockbroker says gold hasn't done near as good as stocks. And I said, well, let's think about it. We were in 1971, gold was at 32 an ounce, and you divide that into 1,700 plus, and, you know, how many times is that, you know, gone up? What is that, 50-something times? The stock market was 600, it's gone 12,000. It's gone up 20 times. And even during the 18 years that gold didn't do a lot, from 1981 to 1999, even including that 18 years, gold has still gone up 50 times, and stock market's gone up 20. And people talk about gold being a bad investment, and they shouldn't own any gold. They should own all stocks, and we'll talk about it a little later. But here's the graph that proves it, and this was an excellent job done by Mark Lundeen, who does with the help of some other. But if you look at this, if you look at where gold, silver, and Dow Jones, the year-end numbers, and then the performance, over the last 11 years, gold's gone up 442%. Now, let me just put in layman's terms what this means. If you'd have put $10,000 in gold 11 years ago and bought it, I mean, at spot, and your real returns may be minus 2 or 3% if you dealt with someone like me or a reputable dealer. So the $10,000 would have gone up to 44,000 plus the 10,000 you had, so your 10,000 would be worth 54,000, or you would have a $44,000 profit. If you had bought silver, you would have had 441,500 plus your 10,000, 51,500. You can take off 2% of that if you want for your net return. And then if you had bought $10,000 worth of stocks 11 years ago, they'd be worth $10,600. We're talking about over a 400% difference in the last 11 years, and there are brokers out there still not selling gold to their clients. They should be fired. It just is ridiculous to be in the middle of a bull market, and we haven't even seen the breakaway to the upside yet that we're going to see when this thing goes parabolic. And but this graph just proves the track record. So if somebody put in 10,000 as 54 or 51,000 compared to 10,600, it just makes no sense why gold isn't the biggest percentage investment you have, rather than 5 or 10% or 0 that a lot of these managers are recommending.
All right. Okay, so the next slide is the investor gold exposure. Now, this is pretty interesting here.
There's a simple one here. And once again, I used the 2009 slide because we have broken through 1%. But back in 81, when we hit the $850 gold, if you took all the value of all the stock markets in the world, all the bond markets in the world, the spot price of gold and silver, palladium, platinum, we got up to 24% of the world investment value was in gold back at that time, and now the gold and gold shares, and now it's just gone over 1%, and people are telling you that we're near a bubble. We haven't even come close to a bubble. Just think, in 1977, gold was 77 an ounce, and in 3 years it went to 850. It went up 11 times in 3 years, and gold right now has gone up 5 times in 11 years. We haven't even come close to seeing a parabolic rise yet. So all that graphs to show is that we've got a long way to go before gold gets into a bubble.
I feel like we've been preaching the same sermon for so long, Tom, and it's just and people are just beginning to catch on. I know there's many people in our audience who have been buying gold for a decade or more, and that's incredible. And many people are just stepping in, and it's a great point to bring out to them that if they're scratching their heads saying, yeah, but gold's like $1,500, $1,600, $1,700. Looking at this chart helps them realize that this bull market is nowhere near from being over. It's
right.
Actually the opposite. Okay, here's another slide, the gold fabrication demand, catching up to supply.
Oh, that's a beauty. That's brand new. That's just out, and we've watched this thing over. And we've already seen it in silver where the industrial and investor demand is outstripping the mining, but in gold it's getting very serious. Gold deposits are getting deeper. We're seeing more and more environmental problems. And literally, there's an article by John Embry out this week on King News that we've hit the pinnacle. Literally, John Embry, and I can't remember the gentleman that's an expert, said literally in the last 3 months, we have hit the point on mining that all that can be mined is being mined, and we're now going to see the red part go down while the blue part is continuing to go up, and sometime this year or next year the demand will outstrip what's coming out of the ground. So that's very, very important, because when that happened in silver 2 years ago, silver went up 83% in the year 2010. I'm not predicting gold is going to go up 83% this year, but certainly people that have waited as long as they can, I'm not talking about the listeners, but large institutions and money managers around the world, they're not going to be able to wait much longer to get into this gold ride, and I think you'll see that evidenced as the year goes along.
We're looking at a 11-year track record here of gold beginning in the year 2000, back when it was $273. And since then, we've seen it rise. Of course, it closed out the year in 2011 at $1,566. Pretty amazing. We've bolded all of the annualized gains, so you'll see that there's been some really big gains and not a losing year for the last 11 years, Tom. Unbelievable.
Yeah, it's averaged right at a little under 18% per year, and like I said, it's already up 8% this year through a month and a half. It's on its way to its 12th straight year, which no index in investment history has ever done. So and I think this year and the next year and the next several years we're going to have a higher average than the roughly 18% we've had the last 11 years. But it's always good for our listeners to see it visually because you look at it and you're sitting there with money in the bank making 0.5%, and certainly we're not saying risk all your money, but there's a calculated risk. If you're going to make a decent return in this world today, you're going to have to take some kind of risk. You can't make even 5% returns without some kind of risk. But it's my belief that we're going to continue at these 18%. Yes, there'll be volatility, and yes, there'll be times it goes down for 2 or 3 months. But the bottom line is we've got a long way to go in this bull market.
Let's briefly list our 15 reasons why we own gold. Number 1, gold is returning to its true historic role as money. Number 2, the inevitability of a collapse in the U.S. dollar, which I don't think anyone can disagree with anymore. Reason number 3, the destruction of government balance sheets. And as we mentioned before, the zero interest rate policies, which are leading us to a place of very bad inflation. Reason number 4, other world currencies are no better in many ways. Reason number 5, we haven't even talked about derivatives, and yet they are the big elephant in the room. Reason number 6, the investment demand for gold, as we've talked about tonight, is rapidly accelerating, but we're still in the early stages of this phenomenon. Reason number 7, there is a growing recognition that many paper gold products, which many of the stockbrokers promote, the GLDs of the world, the ETFs, don't really have the gold backing them up that they purport to have. Reason number 8, mine supplies are not anticipated to rise for several years, if at all. Reason number 9, central banks are nearing an inflection point, and we're certainly seeing them becoming net buyers over the last year or two. Reason number 10, large short positions in the precious metals markets, which we've talked about at length in previous sessions. Number 11, increasing skepticism about U.S. gold reserves, and that's been going on for many years. Reason number 12, the increasing recognition of the fact that gold price has been seriously suppressed. There's a lot of information on that available on our site and also on many other sites. Reason number 13, the relatively small size of the gold market. As we pointed out, the very small ownership as well. Reason number 15, gold is an established, powerful bull market right now, 11 years in. Reason number 15, the increasing likelihood of more purchases of gold by Eastern central banks, speaking of Asian central banks. And the final reason is that gold is endured. It's not like it's a brand new financial instrument. It's been used as money for thousands of years. And so it's really a return, not a brand new phenomenon, right, Tom?
That's exactly right. It's been around, like I said, since the Genesis 2, where gold was in the garden, and it's been around, it's endured, and it refines. The hotter it gets, it's just like a human being. When it get under fire, it refines you, and that's the way gold has been. It refines you because it always brings you back to real value and purchasing power, and it's going to end up doing the same thing this time.
We're looking at a one-year chart of gold, and we began the year, if we go back 1 year from today, this is a chart snapshot of today, a year back, and we see that, gold was just under $1,400 when this 12 months ago exactly, and it really began a nice ride up all the way to $1,900 in the summer, and then all of a sudden the European crisis really got really bad, and of course the dollar began to benefit, and when the dollar benefits, the euro goes down, and when the euro goes down, gold goes down in dollar terms. So the gold was going down, and many people were concerned, and we saw it kind of move into a slump there for a little bit. Now all of a sudden it's been perking up ever since we entered the beginning of the year. Tom, as we look out from this recording, here in the early part of 2012, what are your thoughts about where things are heading? We expected to see a nice bull run in the last part of 2011, and it just never really happened, did it?
No, we still have the reserve currency. The U.S. is still the reserve currency, and certainly when all the problems started in Ireland and Greece, and they were in Portugal and Spain too, but primarily we were seeing the Greece situation in Ireland. People were moving to the U.S. dollar for safety. One thing that's never talked about is if you lived in the Eurozone, you were experiencing the same thing that we experienced for the 10 previous years. Their currency was going down after ours had gone down for 10 years, and we'd seen gold go from $250 to $1,700. They were now starting to hit new all-time highs in the euro, and we tend to forget that it really helped the gold market long term because it was bringing new buyers in from around the world. And you were right, when the crisis hit in the fall, which is ordinarily the best time of the year for gold and silver performance, it just brought it down because the dollar got pushed up to rates it couldn't sustain. We've already seen it drop from 86 down to 79 at a time that all these problems are still not settled, but yet the dollar's had quite a drop, and it's primarily because the volume of money we're creating. So it's just setting up. And the way I look at it from here is once we get by the expiration next week of the future contracts on Thursday, I think that you'll see a lot less shorts bought by the people that are trying to keep the market from getting away. And whether gold breaks down tomorrow or the next 2 or 3 days to 1680 to 1700, almost everybody's predicting when we get to next Thursday, it's going to take off on another run that could take it to 1808 to 1827. And all the newsletters I take, I think everyone on but one are talking about this move starting as early as Tuesday or Wednesday, and that will be the next leg up that we're looking for. And then the rest of the year becomes hard because we had such a fast start, getting 11% gain in January. We've had about a 3% pullback so far in February on gold, but we're still up 8% for the year after only 6 weeks. So I'm still looking for an 18% plus year, and my real gut feeling tells me this is going to be over a 30% year. And tomorrow, which will be the February 17th, we'll be sending out 20 of the top experts. They have been surveys where they think gold and silver will be by the end of the year. So all of you that are on my email distribution will get that tomorrow. And it's certainly worth sitting and looking because these are the people who have had the best track record for the last 10 years in predicting gold and silver.
Okay, Tom, you know, I want to get to some listener questions because there are quite a few. Before we move into silver, we're going to talk about silver and palladium briefly, and then we're going to talk about diamonds before we conclude, and we're going to take some more questions. By the way, you're listening to Tom Cloud, Precious Metals Advisor, been in the business for 35 years and has seen the ups and downs, and nothing but ups for the last 11 years in gold. Now, there's a question here from Ron. Ron says, Tom, would it be a good idea to sell my platinums or palladiums or both and just buy gold instead?
Well, my answer would be no, unless this thing crashes. I think you're going to see all of them do well, and as you'll see in a minute, palladium over the 9 years since I gave the buy signal in it has actually done better than silver or gold. And any kind of inflation is going to generate more demand for cars, and you're going to see with the new 5 plants going into China, and you could easily see palladium be the #1 investment for the metals the next 12 months. Platinum's not going to go up as much as palladium, in my opinion, but it is a good place to diversify. When you're talking about a metal that's 35 times more rare than gold and is at a higher price than gold the last 12 years until the summer of 2011 when it dropped off, I still think you'll see platinum come back above the gold price. It's about currently about $65 or $70 below the price of gold. But I like being diversified in metals. Now, certainly if we go into some kind of major contraction, palladium and platinum should be sold and put into gold. But for right now, I would just sit still.
All right, good. All right, now the next question comes from, let's see here, Jim. Jim asked the question, Tom, do you think metal stocks will outperform the metals in 2012?
If they do, Jim, it'd be this year. I mean, there's just so many problems. I used to be on boards and resigned. I just don't like the way companies handle the money that's flowing into them. There's just so much money coming in. There's so many mistakes made, and there's certainly some very, very, very good mining companies out there, but it's almost like a needle in a haystack. But when you look back over the last decade and see that the physical metals have outperformed those. Now, certainly, if you're in a 401k and that's one of your options, that's okay. And if you want to play that and spread your risk, I think GDX is probably the best one that plays the stocks. But personally, having been in this as long as I have, I don't own a single precious metal stock, not even one share, because I think I was just too close to it back in the 90s.
Yeah, we had Rick Rule on the program not too long ago, and he said, he said gold and silver stocks, you might as well just put your money on the roulette wheel, and because it's just so many things can go wrong. So I agree with you. I like the GDX. I like the GDXJ because you get that grand exposure, and you don't get, your portfolio doesn't blow up if one of them goes out of business or they have a mine explosion or something like that. Now, there's also a question about SLW versus AGQ. AGQ, by the way, for those listening, I'm pretty sure I don't have my screen in front of me, but I remember that one being I think it's the 2 times. So it's the leveraged silver ETF. Those are very dangerous. I mean, because they cut both ways really hard. SLW, obviously being Silver Wheaton, that's a very interesting company. They're a royalty company. They're a silver streaming company. So they've been one of our top picks for a long time. But again, your foundation should always be physical metal and not stocks only. Now, Tom, there's another question. Let's see here. The question from Vicky, and she asked the question, is it prudent to purchase precious metals without leaving a paper trail? And Tom, if so, maybe I'll add the question, how do you do that?
Well, I don't think you worry about a paper trail. I mean, you got to, everything you buy it from has to keep their records. When you go to sell, I put out in the last 3 weeks the reporting requirement rules on what is reported when you sell it. When you buy, there are no reporting requirements, no matter how much you buy, if it's in the form of a check or a wire. Now, you can't, in cash, of course, you can't buy over $10,000 without filling out an 8300 form, but it's just a hard question to answer because any dealer that sells it to you without a record is breaking the law, and most reputable dealers out there are not going to do that.
All right. And we'll have time for one more question here, then we're going to have to keep moving. And then feel free to enter your questions again, and we'll just get to them as we can. There are many. Ward, good to see you. He has a question. People talk about gold being in a bubble. What happens if gold becomes the major asset to back future currencies? What would happen to gold's value if we had gold-backed currencies?
Well, the one that's most frequently mentioned would be the scenario that gold is pegged at a price after they've inflated away as much debt as they can worldwide with cheaper dollars, and then they have to go to there would be an event that would try to shake gold out of your hands and my hands and drive it down to a lesser paper value. At that point, they would declare a gold standard, and whether that would be, North America, whether it's a world standard, there's different debates on it. But let's just say they peg gold at $8,000 or $10,000 an ounce and said they're paying off that. Well, certainly they're not going to corner to where the money supply can only grow at the rate that gold's coming out of the ground, because it would only increase the money supply like 1% to 1.5% a year. So there would still be some kind of ratio, but it would be a ratio where the governments couldn't do the kind of runaway printing and borrowing that's going on now. I mean, they may have that there can be 5% more paper money than there is physical gold to back it, just throwing a number out there. But that's the way that most people in my circles envision it happening, is that they'll just come in one day and peg the price at $6,000, $8,000, $10,000, $12,000 an ounce at that time, and then you turn the gold in and get a new currency. And what will happen is, by you having the gold, you're going to be so far ahead of anybody else, because you're going to have your purchasing power maintained, because whatever the amount of currency you get for your gold is going to purchase the same amount of goods and services when there are a lot more dollars in circulation.
Yeah, the price would have to go up in my mind too, because I mean, as much paper as you have out there, I mean, it would take so much of it just to buy 1 ounce. Okay, we had a couple of write-in questions from people who were not able to attend, but these are really good questions. I'm going to ask you one or two, and then we're going to move on. This question I think may apply to many people in our audience. It says, I don't have a lot of money to buy gold and silver, but I believe that I should buy some, and I want to buy some for an emergency in the event that I need it. Is why I want to buy it. So, Tom, what are the best kinds of metal and what forms of the metal should I buy if I am buying it for an emergency situation?
Well, you got to start with silver. It's going to be barter. Even a 1/10 ounce gold coin's worth $180. So you don't want that. You want silver, and then it gets into the silver eagle, the silver maple leaf, the silver philharmonic, or the silver rounds. Now, if somebody says, is the silver eagle worth $1.25 an ounce more than the silver round, if you're standing there in line and you're trying to buy milk or gasoline or whatever, the silver eagle would probably be taken first. But if we get into that kind of environment where we have to barter, it wouldn't take about 1 day to figure out. Now, for 34 years, I've always said you try to accumulate as many ounces as you can. So what I would say to her is I would buy 1 ounce silver rounds. I'd be sure you got the new ones, whether you got them from me or somebody else. The generic ones are starting to have a little bit of problems as more and more investors come in, the ones that have Santa Claus or baseball players of the past, and it just kind of turns some people off. So we saw that coming, and we changed to all new ones about 18 months ago, and now all the silver rounds we sell are freshly minted, brand new coins.
All right, that's good. So silver rounds would be the place to start if you're looking for an emergency. There's one more question from the write-ins, and this one's another very important one. Whether they have a little bit or whether they have a lot, they got to have to store it. Unless they're storing it professionally, they're going to have to store it in their home or maybe in a safe deposit box. So, Tom, you've been doing this for 35 years. You have your own precious metals. How do you recommend the average novice to the intermediate investor in gold and silver, if they have that stuff in their house, where do they put it?
Well, I think the 3 answers. You get a good home safe, and depending on the value of what you put in it, you either put an alarm on it or not. But the key thing is to get a decent safe. Now, certainly, a small investor that's working their way up, they're not going to be able to afford an expensive $1,800 to $5,000 safe. There's some good safes out there, TANN, T-A-N-N, and the international safe are safes I've used in the past that are really good. Safety deposit boxes, I'm one that don't think banks will be closed when you're in a country this big. I mean, there may be bank closings at some point, but I think it'll just be for a few days like it was in Argentina and Brazil. So it doesn't bother me as much as it does a lot of people to have metal stored in a safety deposit box. There are clients that buy these canisters from Lowe's or Home Depot that are waterproof and bear them in the backyard, or if they have farmland, that makes it a lot easier. But certainly you don't want somebody walking through your yard with a detector and finding your things and out and buried on your property. So you really get down to either home safe, canisters in the backyard, safety deposit boxes, or you leave it in the warehouse and get a certificate. I've been very fortunate to have an arrangement where I have free storage for my clients and insured, and they can leave it and get a certificate that's insured and has right on there what they own. So if they want to leave it in a depository, we can do that for up to 3 years at no charge.
It's so funny. I got to throw this in because you brought up the bank closures, and I'm exactly the same way, Tom. I mean, I'm an economist, Austrian, and I came up cutting my teeth on that stuff. And I have never bought into the banks are going to close, it's going to be chaos. Because why? Why? Because I think that everything's fine? Absolutely, positively not. But if these authorities have learned anything, they've learned how to fool the people. And they've learned that you don't shut down the banks. In fact, you just continue to liquidate the banks with just cheaper dollars. So what they're going to do is they're going to maintain the confidence game. They don't want you to freak out and go buy gold. They want you to keep using their worthless dollars. So they'll keep pumping it out. They don't want to shut the banks down. So in other words, what it is those who are real worried about the economy and how crazy the monetary authorities really are acting somewhat betray their own logic when they say, well, they're going to shut the banks down too, because that doesn't make any sense. That's not, that doesn't even fly, that flies in the face of logic. That's exactly the opposite. It's exactly the opposite of what they're doing. All right. So, okay, let's keep going. What about silver? Because we want to keep this, we're doing real good on time. So we have plenty of time to cover silver, palladium briefly, and then we'll talk about diamonds and answer a few more
silver right now, you just know it's going to explode at some point. There's a vast shortage. It's still an industrial metal first. It's still about 62% of that. Even with all the investor interest in 2011, the industry came out and said that 38% of the silver that was sold last year went to investors and 62% went for industrial uses and electronics and all the different applications. And they're already selling more than they're mining. And I don't think it takes long to figure out that silver, while more volatile on the graph, it's averaged 21.15% over the 11 years, while gold's averaged 18. But it's had 3 years that it went down of the 11 years when gold's had 0. So, and because we had a 9% down year last year, and because the world was afraid of a worldwide contraction or a worldwide recession or a deflationary depression. We heard all these things mentioned. Of course, it hurt the industrial and investment demand for it, but the opposite was true for gold. The more they talked, the more money was moving into gold. Even though the price was coming down some in the fall, it still was money was still moving to gold for safety. But I think this is a year for silver. I really do. I think it went up 21% in January. It had a 6% pullback. It's still up 15%, and we're only 6 weeks into the year. I just see silver being a huge gain. And once again, tomorrow, when you get my email blast, and the ones of you that are listening that aren't on my free email distribution list, just go to FTMDaily.com and click on the precious metals button and sign up. But tomorrow, when you read that, I think you'll see some things. But I do believe silver will exceed $45 an ounce this year, and it closed at $33.50 today. So it's got a long way to go, and I think it'll be a great year in 2012.
Yeah, we made an aggressive buy in a buy call actually on our website when it was down around 29.17. We realized that it was really getting a lot of it had consolidated and it was finding its support, and it just really went up. And you know, you look over the last 11 years' time, we have that chart up, and 21% average return over the last 11 years. I'm with you on 2012 being the year of silver. Lots of exciting things ahead. We're looking at a chart here of silver, and we see that the last 12 months, it's been kind of sideways. It's been kind of a roller coaster ride.
Well, it has been, and I think that's all. A lot of it talk about the deflation and the lack of industrial demand for it when things are uncertain. So the uncertainty has hurt silver, where it helps gold. It actually hurts silver. But I just think, as I said, this year is going to be an incredible run on it. It's already off to a big jump, and when I have suppliers that I've known for many years, and I've been very fortunate, I've never burned any bridges with any suppliers in my career. I've always done what I said I would do, and when they tell me there'll be times this year that they won't take orders unless they have the silver purchased and in the pipeline, and I know that's going to, I mean, that happened in 2008 when the financial crisis hit in June. You know, we were, even though I could take orders and I could place orders, sometimes we had to wait 4 to 5 weeks to get delivery, which was okay. I mean, it scared some people, but you need to buy now before that happens. And when it happens this time, they may just cut it off. I mean, there are a lot of companies that will not take orders if they don't have the silver on contract to buy from mine. So, and I think that's going to come this year.
Oh, wow. All right, let's move into palladium. We got a 9-year price history chart up now from 2002 to 2011. And again, back in 2008, we were down to 184. So again, a very volatile market here. But lately, things have been looking a little different.
They really have, Jerry. And people have been clients of mine for a long time. Know we made a lot of money in 1981. We moved into palladium at like 95 an ounce, and rode it up to 1,000 an ounce in 1999 through the clean air bill when they decided you had to have the catalytic converter, and palladium was the metal of choice. And by 1999, palladium had gone up 10 times in that 18-year period, and then there was platinum sitting there that had nearly the same attributes. It just had a different melting point. And we went out of palladium and into platinum when it was 308 in 1999, and rode that up to 2,000 2 years ago. We went back into palladium 9 years ago because car companies somehow were making the change over. So palladium now, because of being mined in the Soviet Union and Siberia, there's a lot of weather limitations on how many months they can mine. They've had a very cold winter this year, so it really just takes a little inflation, a little demand, and you've got a metal that's 70 times. I talked about platinum being about 30 times, 35 times more rare than gold. Some people out there are saying that palladium is as much as 70 times more rare than gold, and I would not be surprised, as palladium has been for the last 9 years, the top performer overall, if it wasn't for the next year or two, as this takes off, because we are talking about a very rare metal that basically comes from, most of it comes from one area of the world.
So do you view palladium as kind of a speculative play, Tom? I mean, because I can imagine people listening to saying, well, now gold looked good, and now silver sounds great, but now you're making palladium sound pretty good. What's the mix here for a traditional metals investor? Should they be diversified among all of them if they want to have good exposure, just to inflationary protection, or would you say for them to specialize in one? How do they approach this?
Well, I mean, I think you get your silver foundation built because it covers your barter, it covers your emergency. It's a great investment metal. I think that's where you start. But by the time you build up to a little portfolio of whatever that amount, whether it's $10,000 or $1 million, you want to build it up. And I think you'll see gold anywhere between 50 and 65% of 100%, and silver 25 to 30%, and palladium, 5 to 15%. There's no magic numbers. I'm just giving you some guidelines that when I talk to investors. And usually the older the investor, the higher percentage they're going to have in gold, and the people in the 30s, 40s, and even early 50s that are wanting to get aggressive, you put a little bigger percentage in palladium and silver. But certainly they are much more dependent on a growing economy than gold is.
We're showing here the average return per year for palladium for the last 9 years has been 21.78%. Very, very staggering. Here's a 1-year chart again, looking somewhat like a roller coaster, up and down. But right now we have the prices just under $700, right, is where it closed?
That's correct.
Yeah, right under $700. Okay, well, we're going to transition into debt-free stocks. I'm putting the slide up here. This is another area we wanted to talk about before we move into diamonds. Over the last 8 years, Tom, this has been a pretty stellar place to be. Explain what you mean by debt-free stocks, and explain what this chart means.
Well, I've had so many people that they'll say, well, where do you have your money now that you've always preached asset allocation, and now all of a sudden the stocks, traditional stocks aren't doing well, real estate's not doing well, the currencies in the last 6 months have all gone down against the dollar due to what's going on. So where do you go? And it's just one of those things. I just feel God gave it to me early. Is if you just simple and look that gold was money in the Garden of Eden. And it talks about debt-free as you could possibly get. And about 10, 11, 12 years ago, I just started investing in debt-free stocks. And then as my son got into being a money manager, he started researching them and telling me different ones. And these returns are literal. This is not an index. This is the real return of exactly what they have done since 2004 when I started investing in them. And I mean, that is the exact return. So we're talking about companies that do not have debt. And usually they have a breakup where the company is, you could break the company up, it's worth a lot more than the stock, which is just the opposite of what a large percentage of stocks are. So it's just another area for people that are looking for another area while so many traditional areas have disappeared. And bonds have been great for the last 2 years, but now the bond market's starting to get hit with the rise in interest rates on the 10-year and 30-year treasuries over the past 6 weeks. So really outside of metals, I mean, I look at debt-free stocks and diamonds probably as the next two best categories.
When you talk about debt-free stocks, do you have any names in particular that you would recommend or not necessarily recommend?
No, I'm not a stock person. I mean, you just talk to your own broker and find out what that, broker is selling, because the stocks I would mention are some of them are small cap, and I think it's just some I don't want to say out loud on a webinar. I'm not a stock advisor.
All right.
Just a debt stock advisor.
Right.
Debt-free stocks.
Debt-free stocks. All right. All right. Let's see. We do have some more questions here, but I want to keep us moving right along. Vicky has a question about IRAs. We are going to talk about IRAs here in a couple of minutes. We're going to talk about diamonds in just a couple of minutes. She has a question, though, that says, is it a good idea to take out half of our IRAs that are invested in dollars currently and pay the tax and purchase gold and silver? So what she's asking, Tom, is should she cash in her IRA now and buy gold and silver? Would you recommend that?
Well, I mean, that's a very personal decision. I've seen literally hundreds of people do that. And, of course, if you're 59 and a half or older, it makes it a lot easier, because then you just have to pay the tax, and you have to pay the tax anyway. You go on and pay it now and pay the tax, get your metals, and then you own them, you have them, and away you go. So to go in below 59 and a half, and you start looking at paying the tax plus a 10% penalty, for some people it makes them much more comfortable to know they've done that. I've had so many people tell me it was very hard for them to pull the trigger, but once they did, they've had a peace with it. And certainly, it's like you want to wait around to see who's going to be elected president later in the year to make that. And certainly if Obama is reelected, it's my belief there'll be a lot of people doing what Vicki is talking about. But between now and then, I think it's a pretty tough call, and one that they need to pray about and think about. And I don't really think there's a bad answer. I think because it's how the peace of mind it gives you if you do, and the peace of mind it gives you if you stay where you are and hope things improve, and that the government never goes after those retirement accounts.
Right. Well, and I would imagine, too, if they call in and you're able to see their financial situation, you can actually probably answer that question a lot easier than just on a webinar.
Yes.
Sure.
Yes.
All right. Well, another thing, too, I should mention, just as a plug, I forgot, Tom and I are going to be on a boat. We're going to be on a boat together in the middle a big boat in the middle of the Mediterranean. I don't have a picture of this because I just thought about this just now. We're going to be over in the Mediterranean. doing a financial conference on a boat, on a big cruise ship. We're going to go to, where are we going, Tom? We're going to the pyramids.
We're going to leave Rome.
Yeah.
We're going to leave Rome on October 17th, I think it is, and we'll cruise to Egypt and go in to see the pyramids one day, go into the King Tut Museum one day, and then we'll cruise up to Israel and tour Jerusalem for a couple of days, and then we'll go up to Haifa from Ashdod and go to the Sea of Galilee and the Valley of Armageddon, and then we'll come back, get on the boat, and sail to Ephesus, and then we'll go from Ephesus up to Corinth and Athens, Greece, and then we'll go to Crete, and then we'll go back to Rome, and it's a 13-day trip, and Jerry, myself, my son Tommy, that's the debt-free stock expert, and a big name, a man that manages several $100 billion with a B, not M with an M, but B with a B. Dynamic Christian guy is going to be with us, and all that will be released this weekend with his name. Of course, Jerry and I already know who it is, but the public doesn't. But that will be released this weekend. So we're really excited, and we're calling it the presidential conference. We'll be addressing every single possibility as to who gets elected, Congress, Senate, what we can expect the next 4 years, and not only will it be educational and hitting some great places, I think it'll be worth your waiting, literally, to come in there and save your money and look at where to invest it over the next 4 years under every scenario.
Yeah, I think it's really good. And, so we're going to be doing that at the end of the year. There'll be some information, obviously, out on FTMDaily.com. Be watching, and you'll see information about that cruise if you're interested. Okay, so let's keep going. There's a quote up right now, Mark J. Lundin, and, he has a lot of great charts, and it says, printing dollars doesn't produce wealth, though it does allow a select few to consume more than they produce at the expense of the many. Private sector increases in salaries and wages in response to rising consumer prices will never compensate workers for losses inflicted on them by our corrupt monetary system, but that was the whole point of taking the dollar off of the gold standard. Just a little bit of wisdom there as we kind of take all these facts in and realize that this thing has been many decades in the making. It's a very, very strange thing as we look out at the election 2012. Tom was just making a comment about some of the different scenarios. We have all four listed here, Tom. Number one is that Obama gets reelected. Why don't you go through these and just briefly talk about these before we talk about diamonds?
Well, I think we're going to be looking at whether we're looking at income stream investments. Jerry's going to be doing a great talk on income stream investments. I'm going to be talking about gold and silver and the economy, and Son on debt stocks, and the other money manager on fixed income products and everything. We're going to look at all that, so you really just get to hear a full scenario from 4 different experts. And another speaker that's going is going to be a young man I met when he was 32, and he just called me about once a month for 13 years and saved his money and retired at age 45, and he's going to be going on the trip to give a small presentation of what how he's done it, and hopefully encourage others, investors, on what to do. And he'll be laying out exactly not only what advice I gave him, but other areas he looked at. But in 13 years, and this is a gentleman, he made a very good living, but we're not talking about somebody making mega bucks that just through his investments was able to retire in 13 years.
That's pretty amazing. Well, this slide we have up now talks about the election 2012 potential outcomes. The very first one is that Obama is reelected, and that's obviously a scenario that we may see. A Republican candidate could be elected in 2012. Obviously, there's a lot of ideas, Tom, on what that would look, how that might be different than Obama getting in. Many people think, well, that would be instantly better. I don't know. I mean, we look back and we see that, it's been difficult no matter who's really been in office, because the issues at hand, even though many of them could be fixed with better policies, overall, these issues are gargantuan. The other one is that Democrats take control of the House and the Senate versus the Republicans taking control of the House and the Senate. Any ideas on what you expect to happen at the end of 2012?
Well, I mean, right now, I'm just looking at the polls like everybody else, and of course we'll be looking at the polls real close once we know who the Republican is. But right now in these polls, Obama can beat any of them. So it's a little scary. But of course, once everybody gets behind one candidate, the Republicans, it could change. But I think we're going to wait till August really to know the answer to that question.
Yeah, I agree. Well, those are definitely the outcomes that could happen. Now, we have this slide up, Tom, about kind of where you sum all this up. Why don't you briefly talk about that?
It's just my pet peeve. I started by saying Paul in Galatians, when he went to Galatians, they started wanting to go back to legalism and the old law, and they just couldn't understand the mercy and grace that Christ had provided for them. And I just started out saying stinking thinking goes way back, but the allocation, what we talked about earlier, how in the world a financial person that's a financial planner or has fiduciary responsibility does not have a handsome percentage of their money in that? That's just got to be stinking thinking from every standpoint. And the one that kills me is that we keep saying the economy is going to get fixed by somebody, and people just keep going on and not investing while they got a chance. They just act like this thing's going to get fixed. Trillions of dollars of future obligations plus trillions of dollars of debt is going to get fixed overnight. And then I really believe, as I said earlier, the next 3 to 5 years will be the largest shift of wealth in history. We'll have people that are haves become have-nots, and have-nots become haves. And the other stinking thinking is these rare coins. They still are a big pet peeve when I have to tell people they bought something and paid a 30 or 40% commission from a telemarketer, and if they had just bought gold bullion or silver bullion, they'd been up 11% last year instead of down 20 or 30% because of the commissions charged in buying the wrong products. And then bottom line is that no matter what's out there, we can't blame it. We've got a responsibility to be good stewards of our money. We've got a responsibility to our families. We've got responsibility to ourselves. And we're told in Proverbs, you go to many different advisors, and that's the reason we set this cruise up. And all of us don't think alike. You'll hear some contradictory things, but the point is you've got to go to different advisors and be responsible for yourself, which a lot of people don't want to be. They want to turn it over to somebody and either blame them or thank them, and I just think that's not the right way to be thinking.
Yeah, good point. All right, real quick question now. Can a person buy precious metals in their IRA? And it looks like that's a yes or no question. I did notice
I did say yes, and they can go to sterlingtrustcompany.com and peruse around and just call me for more details. We won't hang on this, but Sterling, STERLING, Trust Company, spell it all the way out, .com, and look at the precious metals, our self-directed precious metals IRA, and there's question and answer section there. But yes, the answer is yes, and they can give me a call at the office to help them with that.
Yeah, and his number is 800-247-2812 for those of you who are listening perhaps afterwards, or those of you who are wanting to ask a question that may be a little more specific. Just call him and talk to him directly. 800-247-2812. That's Tom Cloud. All right, Tom, I want to focus in investing in diamonds here in the last 15 minutes as we wrap this up. Diversification in your plan. Now, we are looking at diamonds. They've been up over 13.8% per year since 1938. I have a slide up right now that shows the way that a diamond's quality is assessed. There's really 4 C's that are involved here, Tom.
Yeah, the carat weight is, the bigger the carat weight is, the rarer it is. If it's the same color, clarity. The cut is probably the most underestimated. You want cuts with no deductions. We're talking about the depth percentage, the table diameter, the inclusions, where they are, the girdle thickness. There's all these different things that are on the certificate, and people just usually look at the color and clarity, but there's a lot more to it. And if you look at the next slide, it just shows you it shows you the real sizes down there, which is just educational. And when you're looking at, an investment grade diamond, it really has changed over the last 35 years I've been in it, because it used to be the highest grade diamonds, and lately the ones that have gone up the most have been the ones that have the biggest demand. But certainly I sent an email out last week showing about 15 diamonds that sold for $1 million to $30 million at auction in the last 3 months, where every single colored diamond exceeded the bid estimate. But the key thing, Jerry, in diamonds, and this is so important, because if Obama is reelected, we know the estate tax is going to come back. And I know, as I talk to people that are wealthy and people that aren't wealthy every day, one of the things that's going to drive these diamonds up at, I think, a higher rate is going to be people buying them for confidentiality. They're buying them for portability. They can take them anywhere in the world and sell them. You can literally stick them in your pocket and walk through any detection device in the world. And I just think you're going to see not only the rarity of these diamonds, but demand is accelerating quickly in the Middle East to have things. And it's rumored that a lot of diamonds are flowing into Iran, and Israel always has had a big take in diamonds. So between the confidentiality, the portability, taking them liquid anywhere in the world, I look for diamonds to be, after the metals, to be the next big mover.
Yeah, and if you listen to the mainstream media, they're continuing to promote, the same old, the good growth mutual funds and all of this, buy term and invest the difference. Meanwhile, this email you put out is very revealing, plus some of the journals that I read too are showing that the big money is flowing into tangibles. It's not flowing in to the mutual funds. It's not flowing into where middle America continues to be told to invest. When middle America is told by the mainstream media where to invest, you can guarantee that's not where the smart money is investing. That's where the smart money is taking. We had Robert Kiyosaki, Rich Dad Poor Dad, and he's been on our show a few times. And he's told me over and over again, when you put money into your 401k, when you put money into your mutual funds, you're giving money to guys like me so I can go spend it, because that's exactly what these vehicles are. So the big money that's out there is flowing into tangibles. And this email you put out, Tom, was pretty interesting, from King World News and Richard Russell, showing some of these amazing prices that diamonds are fetching. Now, many of these diamonds, Tom, the average listener to this webinar is not going to be able to afford. But you mentioned that what you like right now are yellow diamonds. Talk about yellow diamonds.
Well, yellow diamonds are more abundant. I mean, the greens and the pinks and the blues, you start talking about $50,000 per carat up to $400,000 or $500,000 per carat, or even over $1 million per carat for a GIA red diamond, because there's so few of them in existence. But in yellows, they're more abundant, and there's the three top grades are vivid yellow by the Gemological Institute of America, and then fancy intense yellow, and then fancy yellow. So vivid's the brightest, and then fancy intense, and then fancy. But you can still buy, even after the run-up in prices the last 3 years, you can still buy nice yellow diamonds for $4,500 a carat for nice 1 carat stones, or $3,500 a carat for 3/4 carat, half carat stones that will be good investments. Now they won't go up as much that if you can afford a $4,500, and they won't go up as much if you can afford a $10,000 one. But it certainly is a great place to diversify your portfolio and get a percentage, whether it's 5% or, I have clients from 0 to 10 they have just in diamonds because of the attributes that you got, and certainly in those there's no storage problem when you start talking about something with that kind of concentrated wealth.
What kind of tax implications are there on diamonds? What's the tax? If they buy diamonds from you?
Well, they are collectible. I mean, there's no reporting requirements, but certainly in the United States, if you buy something and later sell it, you've got a taxable event. And what Obama did 2 years ago is because collectibles and bullion, some of the bullion was on things going up, he changed the capital gain tax to 28% on that. So diamonds, if somebody bought a diamond for $10,000 and sold it 3 years later or 4 years later for $20,000, they'd have a $10,000 capital gain and owe $2,800 in capital gains tax. So they would have gotten back $17,200 net. But there are no reporting requirements when you sell it, but there are, it is a taxable event.
Yeah, and they're super easy to hide, as you mentioned. I mean, you could walk through a TSA, screener,
easy.
and they're not going to be able. You can slip out of the country with these things on you, and you're not lugging around the gold. So the diamonds are pretty interesting. They offer the asset protection for those who are concerned about the confiscation, which you and I aren't as concerned about that with gold, but nevertheless, confiscation doesn't necessarily mean them coming out and taking it. That means them changing the rules, so to speak. So,
right.
So diamonds really do help. And it's also kind of a nice thing if you're thinking about moving your assets offshore. Diamonds kind of fit right into that because you can take these assets offshore very easily. Are diamonds easily are they very liquid, Tom? I mean, if they buy one, can they instantly liquidate it, or is
well, it's not like gold and silver where you send in and have a check back in 7 or 10 days. But yes, because there is a little subjectivity even with the certificates. Anybody's going to buy a major diamond dealer is going to have to look at the diamond because, like I said, there's not a trading system or it's not a homogeneous product like gold or silver where, it's just different designs on it, but it's still 1 ounce or half ounce. So you do have some subjectivity, some human opinion, but it is liquid. You are going to get plenty of bids on anything that I would sell to you. You would have, you can take it anywhere in the world, and you're going to be able to get a price on it because we're only going to sell good diamonds that are well made and have liquidity anywhere in the world. But sometimes it may take you a few weeks till you settle on a price. But you do have to, if you were doing it on your own, you'd try to see 2 or 3 different people to get bids. But we provide the service to help them rebroker it at no expense. We know where to call and help them sell it down the road.
All right. In summary, we want to say that holding physical metals is very important. When we say holding, it means not just owning it, but also having it in your possession, whether that's being stored for you by someone that you trust or by being held in your physical possession, which is probably preferable. Gold will perform very well. We expect silver to do even better. That's certainly what we've said tonight. And also diamonds. You should consider these because they make a great addition to your portfolio. But, Tom, as we mentioned, you typically want to keep that exposure low. You don't want to have 50% of your portfolio in diamonds, right?
No, absolutely not. You want to keep the exposure low, and in my opinion, you should have metals before you even look at diamonds.
Perfect. Okay. All right, so how do they buy gold, silver, diamonds? They simply call you, but let's talk about what that process looks like. They call you, 800-247-2812, and they say, Tom, I heard the webinar. This sounds pretty good. I'd like to buy some gold. I'd like to buy some silver. I'd like to buy some diamonds. What happens from that point? What do you do with the client at that point?
Well, what we've done, Jerry, having done this all these years, I've been fortunate enough to deal with good people. So when they place an order, I am willing to use my credit to buy whatever we agree on, whether it's gold, silver, palladium, or platinum. We'll buy it, and we will email them an invoice, that day. They have 2 weeks to send us a check. Now, whether the price goes up or down tomorrow doesn't make any difference. If they bought it today, they're they bought it, and we've agreed on a price, and we've emailed them an invoice, and when we receive, they can pay us in personal checks, wires, or bank checks. And if it's a wire, we'll send it out the next day. If it's a bank check, we'll send it out in 2 days. If it's a personal check, we'll send it out in 3 days after the check clears. But I know that there's nobody delivers metals faster than I do, to my knowledge. I've never seen anybody that gets them out as quick as I do. So we'll get the metals right out to them, and that's the way it works. And then when they're ready to sell it, they just call. We'll see which warehouse we'll have them send it to, depending on who we're going to sell that particular product to, who's paying the most. And then once they mail it and call with a registered number, we lock in the price. Of course, they'll know very close to what they're going to get before they walk in the post office, but the actual price, when they're liquidating, is determined once we know that they have mailed the metals. So it's a real simple process.
Yeah, most people have probably never done this before. They're used to buying stocks or something like that, but this is a different kind of process. But you've been doing it this way, and you've been using the U.S. Postal Service, as do all other gold and silver dealers, I assume. I mean, that's pretty interesting.
Well, we're using FedEx now. We finally got an insurance carrier. So if people buy gold, and I do need to make a point, because some people out there already know this, but if you bought gold and silver in the same order, depending on the value of it, we're ordinarily going to overnight the gold to you, but there'll be a packing slip in there that shows gold and silver, but the silver actually goes UPS. And we've been very fortunate with this boom market to get better rates and get FedEx and UPS as well as the U.S. Postal Service. So if you have a post office box, it always goes U.S. Postal Service. But if it's going to a street address, we're probably going to overnight the gold to you, and we're going to send the silver by UPS, and someone will have to sign for it before you're responsible for it.
All right, and if they decide they want to sell the metals at a certain time, they can do that, as you said. And what do you charge on the back end for them to sell it back?
We don't. I've never charged on the back end. I work on very low fees, as people dealt with me know, and we'll just see which wholesalers paying the most and have you send it there, and we'll get a check and send it to you.
Perfect. Another question I saw, can people put diamonds in their IRA, Tom, just like gold and silver?
No, can't put diamonds in an IRA. They're not cleared, just like real coins aren't cleared. Diamonds are not cleared for an IRA at this point.
All right. Well, you have been very informational tonight. We clocked in right at 90 minutes, so we did good. I want to take a look and just see if there's any final quick questions, that we want to ask before we run. I know we have tons in here, but many of these are pretty detailed, and we don't have time to get into the details. Any just quick remaining questions for Tom? We will tell you that he's available at 800-247-2812. That's 800-247-2812. If you have not already signed up for his email newsletter, do so at FTMdaily.com. That's FTM, like follow the money, daily.com. And we will be happy to get that out to you. He sends out, you probably send out one of those or two of those or three of those a week, Tom. It's not too many, but at the same time, just enough to keep you informed of what's really going on. So,
yeah, that's exactly right.
All right, well, let's see. We have one little question that came in. Let's see. What is the largest quantity that can be sold back without being reported, Tom?
I just put an email out on that 2 weeks ago. It's more about the product. Over 24 ounces of up to 24 ounces of anything you can sell in a calendar year without a 1099-B. If you go over 24 ounces in a combination of Canadian maple leafs, Austrian philharmonics, Australian kangaroos, 1 ounce, 10 ounce gold bars, they're mostly 24 karat products. The only 22 karat product that can be 1099 is a Krugerrand. So a lot, if you don't want a 1099B, you need to stick with gold eagles or the European coins, British sovereigns, Swiss francs, 20 francs, Austrian coronas, those kind of coins. But all you can do per year, the 25th ounce in a calendar year produces a 1099B for everything that you sold.
So it's not it doesn't matter how much it is, it matters how many ounces. Interesting. So it's not a dollar.
That's right.
Interesting.
Yeah.
All right, Tom. Well, that brings us to the end. Thank you so much, my friend. I know it's late out where you are out in the East Coast, so I appreciate you taking time to do this, but this has been very informational. I know the folks are very happy to hear your insights on all these things, and I wish you a wonderful evening, and we'll look forward to seeing you on Follow the Money Weekly radio show next weekend.
Well, thank you, Jerry. Appreciate it, and we'll talk to everybody a little later.
All right, thanks. Bye-bye.
Good night.